SpaceX just reported its first quarterly results as a public company. For years, the company was mostly a private story about rockets, satellite internet, and long-term ambition. Now the market can see the numbers more clearly, and the numbers are large. Second quarter revenue came in around $7.8 billion. That was roughly double the same period a year earlier and stronger than many analysts expected. At first glance, it looks like a simple growth story. But the more interesting question is what kind of company investors are actually buying. Is SpaceX mainly a launch company, a satellite internet company, or an AI infrastructure company wearing a rocket badge? The earnings report suggests the answer is all three at once. Start with Starlink. Connectivity revenue was still the largest piece of the business, at about $4.3 billion. Subscriber numbers kept rising, and the unit remained highly profitable. That matters because Starlink is not just a futuristic product. It is the cash engine. When a company is spending heavily elsewhere, investors want to know which part of the business can fund the risk. Starlink is currently that part. Then comes AI. The AI segment jumped to roughly $2.6 billion in revenue. That is a huge increase from a year earlier. Part of the growth comes from compute contracts with major technology customers. In plain language, SpaceX is not only launching rockets. It is also selling access to expensive computing power. That is a very different business model from selling a single launch service. Launch revenue can be lumpy. One mission slips, and the quarter changes. Compute contracts can look more recurring if customers keep renting capacity over time. That is why the AI story is attracting so much attention. But revenue is only half the picture. The other half is spending. Capital expenditure in the quarter was enormous, around $18 billion. A large share of that money went into AI infrastructure. So yes, AI revenue is rising. But AI-related investment is rising even faster. That creates a familiar tension in modern tech markets. Growth can look impressive, while free cash flow still feels under pressure. SpaceX also reported a net loss of about $541 million. Losses are not automatically a disaster for a high-growth company. The key question is whether the spending is building durable demand. Investors are not only asking, is Starlink popular? They are asking, can Starlink cash and AI contracts support this level of investment? And they are asking a second question too. Can the company keep expanding AI capacity without making the whole story too hard to understand? Opacity is a risk in any high CapEx cycle. If the money path from spending to profit is unclear, even strong revenue can make markets nervous. That helps explain why strong results do not always produce a calm stock reaction. Markets can celebrate growth and still punish heavy cash burn, especially right after an IPO, when investors are still learning how to value the business. Zoom out, and the bigger idea is simpler. There are two stories inside one earnings report. Story one is operating strength, Starlink demand, rising AI revenue, and a company that is expanding faster than most people expected. Story two is capital intensity, huge investment, continued losses, and a market that wants proof the spending will pay back. In other words, SpaceX is no longer just a rocket narrative. It is a test of whether connectivity cash flow and AI compute demand can support one of the most ambitious infrastructure build-outs in technology. That's all for today's episode. Strong growth can still come with a very large bill. Thanks for listening, and we'll see you next time.
Subscribe for new episodes and turn on notifications so you never miss the next one.